Have you felt like the rules of business funding were designed to keep you in the dark? Maybe you were denied and could not get a straight answer from the underwriter. Maybe somebody sold you a fast money product that drained your cash flow. A lot of the noise out there sounds authoritative, but it's often wrong or incomplete. In this video, I'll expose the 7 common lies, give you the truth that replaces each one, and share practical steps you can take today. My name is Zach Siegel, and I help business owners acquire funding the right way. I aim to educate first and fund second. I've also worked with a wide range of programs: bank lines, SBA, term loans, equipment financing, invoice factoring, equipment sale leasebacks, 0% APR credit cards, personal term loans for startups, fleet and vehicle programs, and cash advances when they make sense. The point is to match the right product to your numbers and your use of funds. With that said, here's the 7 lies I see the most often. Lie number 1, you can't get funded with a low personal credit score. Truth. If revenue is strong and your business profile is clean, funding is absolutely possible, even for business owners in the 500s. Revenue-based financing options, equipment lines with clear liquidatable collateral, and invoice-backed products can bridge the gap while we build your EIN profile and we work on your personal credit towards the more conventional stuff like bank lines and cards. Lie number 2, business credit builds automatically as you operate. Truth. It does not. You must choose vendors and add cards that report. Action. Add 3 reporting vendors today. Use them for real purchases. Pay on time or early. After 1 month, add 3 more so you have 6 trades growing in parallel to each other. Confirm they show up on your reports after 2 cycles. Then if you drive, add a fuel program that reports too. Lie number 3, utilization rules are the same for all credit. Here's the truth. Keep utilization low on revolving cards, personal and business, but vendor trade lines are different. The high use of vendor terms does not hurt you the way that card utilization does. Use vendor terms aggressively when it supports your operations especially, and then make sure to pay early or on time. Here's an action. Move recurring expenses to vendor accounts that report and pay before the due date. Keep card utilization in the 10 to 30% range. Lie number 4, it takes years to build business credit. Here's the truth. With intention, you could build a credible profile in months, not years. Here's an action to get started. In the first 60 days, lock in your business address, match it across all filings, open the business bank account, add 6 reporting vendors in 2 waves, 3 1 month and 3 the next, and keep payments early for them. By month 3, you can apply for a basic business card and an EIN-based store program like a Costco or an Amazon business account with really high limits. And then make sure to keep your file in good standing with real purchases and on-time or early payments. Lie number 5, merchant cash advances are always bad. Here's the truth. They are expensive, but you got to use them as a tool. For a lot of companies, an advance with strong prepayment incentives can be an extremely useful bridge when that's all you qualify for. Then we work on positioning you and setting you up for getting approved for a bank line or an equipment facility or something more conventional. Action. If you take one, use it only with a defined payoff plan and make sure you have a measured ROI or return on your investment for the use of funds, and then a timeline to replace it with cheaper capital, and that way it's actually being used as a bridge the way that it's supposed to be used. Lie number 6, if one lender says no, everyone will. Here's the truth. Lenders have different scorecards. One cares about average daily balance. One values trade references. One rewards net profitability trends. One cares about personal credit. Another focuses on collateral. And some of them prefer different industries than others. A no from one can be a yes from another. Action. Build a targeted lender map by use of funds. If you need to bridge receivables, prioritize lines of credit or invoice financing options. If you need a truck, go towards equipment financing or fleet credit. If you need a marketing push with a short payback, a card or some short-term working capital may be a good fit. Work with a professional to pre-qualify and use soft pulls wherever possible. Lie number 7, you should just apply everywhere and see what sticks. Truth. Shotgun applications create inquiry sprawl and messy files. It's a really small industry. If you're applying everywhere, the lenders are going to start talking. You want to curate curated submission plan. Action. Coordinate a sequence of applications in a 2 to 4 week window. So that way you could stack pre-approvals and use one pre-approval to make the next pre-approval cheaper for you. Keep your inquiry footprint controlled throughout this process. Use bank statement reviews and soft pulls when available. Use companies that look more at your cash flow and make sure that they only do soft pulls up front. Let's go over these again. First, lock in a professional business address and use it everywhere. Second, align your legal name, address, and contact info across the Secretary of State, IRS, business checking account, utilities, website, everything. Consistency matters. Third, open the business checking account and route all deposits through there. Fourth, add 3 reporting vendors, and after 1 month, add 3 more. Fifth, add a fuel program if you drive, then 1 business card and 1 store line under your EIN. 6, keep card utilization under 30% and pay vendors early. Here's exactly what you should be tracking monthly. Number 1, number of reporting trade lines. Number 2, on time and early payment rate. Number 3, average daily bank balance with a target of 0 negative days per month and a cushion of money in the bank at 10% of your monthly deposits. Number 4, utilization on your revolving cards. Remember, anywhere from 10 to 30%. Number 5, net profitability. Is it trending upwards or downwards? Number 6, many bank scorecards reward rising net profit even more than raw revenue growth. Here's a scenario. Miguel runs a mobile auto detailing company with strong revenue, but a personal score in the low 600s. We aligned his filings, opened 6 reporting vendor accounts in 2 waves. Then we added a fuel program and kept card utilization under 20%. He then secured a $25,000 equipment financing loan for a van and also a $20,000 working capital credit facility to add a technician to his payroll. As his statement stabilized and his personal credit went up, he refinanced that working capital loan into a lower cost bank line of credit. Before we wrap, here's an advanced map for owners doing $50,000 a month or more in revenue. Start with a 2-week data prep. Reconcile your books, profit and loss, balance sheet. Download your last 6 months of business bank statements as PDFs. Do not redact any information because real banks and lenders are not going to accept redacted bank statements. Confirm your business address and legal name is consistent across your Secretary of State profile, your EIN letter from the IRS, your utilities, your business checking account, your merchant processing account, your website, your Google listing, everywhere. Set your target cushion at 10% of average monthly deposits if it's not already there. Then in week 3, open your first 3 or confirm 3 to 6 reporting vendors and begin recurring purchases on those lines if you haven't already. In week 4, add 1 business card and 1 EIN-based store program and keep card utilization in the 10 to 30% band while vendor utilization stays high with early payments. Week 5 to 8, run a curated submission window based on use of funds. If you are bridging receivables, prioritize a line of credit and invoice financing option for those receivables. If you are, or working capital, easy, or revenue-based financing for the flexibility and quickness of it. If you're buying equipment, submit your file to 1 or 2 equipment lenders that frequently lend to your industry specifically. If you need a short runway for a high return campaign in your marketing and a bank line is not an available option to you yet, a short-term credit facility with strong prepayment incentives can be a great temporary bridge. Space submissions between all these applications between 2 to 4 weeks apart, so each approval posts before the next review. Weeks 9 to 12. Request moderate credit line increases after 2 or 3 clean cycles of earlier on-time payments. Keep credit card utilization low. That's building your business credit proactively. Keep your vendor payments early. Track average daily balance and negative days weekly so there are no surprises. If you're keeping 10% of your deposits in the bank at all times, then you shouldn't have to worry about negative days. At this stage, you could even add 1 more reporting vendor if you need to reach 8 or 9 trade lines for a vehicle or fleet program. Many underwriters weigh average daily balances, the count of negative days throughout the month, the trend in your monthly deposits, the number of business credit trade lines that you have reporting on time or early payment rate, and your net profitability trend. Some programs add add industry risk, seasonality, collateral strength, or receivables concentration. Align your submissions with the programs that reward the data you already have. Every dollar should have a plan to return more than it costs. Inventory with bulk discounts is a great investment. Equipment that increases billable capacity is another great investment. Hiring more people tied to a signed contract for a bunch of new clients and new work to be done is a great investment. Ads with measurable cost per acquisition and payback windows, great investment. Do not fund chronic losses. Fund projects that pay for the tool or the cost of your capital. Here's some common objections I hear. Should I wait until my personal credit score is perfect? No. If revenue and your business banking behavior is strong, you can build the business credit history now and step into much better options as your EIN history grows and you improve your borrowing profile. Having that repayment history will help your odds of a much higher approval and lower rates in the future once your profile does improve. Will early payments really move the needle? Yes. Early payments on vendor trade lines often elevate internal scores at all three business bureaus, especially Dun & Bradstreet Paydex. Quick recap: build on purpose, intentionally, pay early, keep cards light and vendor terms active, target lenders by use of funds or ones that lend specifically to your industry rather than chasing a single favorite product. There's lots of people that try and get an SBA loan when an equipment financing loan might be better, or factoring, just because they hear SBA is the best. Coordinate your submissions so your file stays clean and strong. Don't shotgun your application brainlessly, throw spaghetti on the wall, hope it sticks or whatever. We never guarantee approvals. No lender should. And every decision that you make should be based on real numbers, not hope. That said, if you want me to review your setup, we offer a free evaluation. We'll look at your entity, your active trade lines, if you have any. If not, we'll help you get set up. Your business bank statements, we'll talk about your goals, then map your next best move. The link to have a brief conversation with us is in the description. Click it and pick a time. If this was helpful, subscribe for more content, share it with a friend, and make sure that you're protecting your future and opening doors to real funding options.